to set up our company and we're going to start with the balance sheet. And if you remember on the balance sheet, the only two things we find are our assets and our liabilities. And if we deduct the liabilities from the assets, we get the net assets. And these net assets are represented by or are the same as the shareholders' funds, which is any investment by the shareholders and any retained profit. And let's say it's Sunday evening and you and I are going to go into business together, and we're going to go into business selling these sunglasses. So we invest $50 each. You invest $50 and I invest $50. What are the assets of the business? Well, it's $100 in cash. What about the liabilities? Well, we don't owe anybody anything, and therefore the net assets are $100. What's the original investment by the shareholders? Well, we've invested $100. The retained profit, well, we haven't done any trading, and therefore there is no retained profit, and therefore the shareholders' funds is also $100. The balance sheet balances. That's good. So what we could do is we could put our company into liquidation. And if we put our company into liquidation, then we take that $100 in cash and you get $50 and I get $50. And you'd probably be sitting there thinking, well, that was a waste of time, wasn't it? Why would I invest $50 to get $50 back? And you'd be right. So we don't want to close our business down. We want to start trading. And if the balance sheet is a snapshot in time and shows our assets and our liabilities at a particular point in time, then the income statement or the profit and loss account is our trading account. And this is where we show our sales and our costs. And if the sales are greater than the costs, we'll make this thing called a profit. So here we go. You and I, we take $100 cash, we head off down into town and we find a guy who's at a street market and he's selling these sunglasses and he's selling them for $1 each. And we think there's money to be made. So we say we'd like to buy 100 pairs of sunglasses for $100. He says no problems. He hands me a bag of sunglasses and you hand over the cash. And as we walk away, I turn to you and I say, who owns the sunglasses? Well, it's pretty obvious who owns the sunglasses. We do. We've bought them, we've got them, we've paid them. They're ours. And if they're ours, we can do with them whatever we want. And what do we want to do with them? We want to sell them. So we head down to the beach, we find a shop that is selling sunglasses, they've nearly sold out, and we explain to them how we've got a once only, never to be repeated special discounted offer, $5 a sunglass per glasses. And the shop manager says that's an absolute bargain, I'll take the lot. So he hands over $500 and we hand over the sunglasses. Who owns the sunglasses? The shop manager. And if they own the sunglasses, we can record the transaction in our books. So we've made sales of $500. They cost us $100. We made a profit on the transaction of $400. And at the end of Monday, we can now do our balance sheet again. How much cash do we have? Well, we started with $100 in cash. We turned that $100 in cash into sunglasses. We then sold those sunglasses for $500. So we've got $500 in cash. Do we have any other assets? No, because we've sold the sunglasses. Do we have any liabilities? And for the sake of this example, we'll ignore tax, for example, just to keep it nice and simple. So the answer is we have no other liabilities, and therefore the net assets of the business are $500. The original investment is $100, and the retained profit, well, we started the day with nothing. We went out, we traded, we made a $400 profit. We haven't paid any dividends, and therefore the company owes the shareholders $400. 400 plus 100 is 500. The balance sheet balances. Now, at the end of Monday, we could put our company into liquidation again if we want. And if we were to put our company into liquidation, we would take that $500 in cash, and you would get $250 and I would get $250. And the $250 that you got would be 50, which is your original investment, plus half, because you own half of the company, of the retained profits. But we don't want to do that. We want to carry on trading. So here we go. It's Tuesday. We head off back into town, you and I, and we find our street market and we find our chap selling these sunglasses again. And we say to him, we'd like to buy another 100 glasses for $100. So here they are. We want to buy another 100 sunglasses for $100. And he says, no problems. And he hands us a bag of 100 sunglasses. Now, unfortunately, we've forgotten to bring the cash with us, so we can't pay him. So there's a little bit of a problem, and then he says, it's okay, you look honest, you can pay me tomorrow. So we write him a little note saying, I promise to pay you tomorrow, and we walk away with a bag of 100 sunglasses. Now the question is, who owns the sunglasses? Well, there's an easy test here. If we're walking along and we drop them in the street and a lorry comes along and flattens them, whose problem is it? And the answer is, it's our problem. And if it's our problem, it means that we own the sunglasses. The title of goods have passed. And if the title of goods have passed, it means we can do with them whatever we want. And what do we want to do with them? We want to sell them. So we go down to the beachfront, we find our sunglasses store manager, and we explain how we managed to extend yesterday's once only, never to be repeated special discounted offer. It's $5 per set of sunglasses. He says that's a bargain because I'm selling lots of sunglasses. I'll take the lot. But he says, I've lost the keys to the petty cash tin. I cannot pay you today. We say that's no problems. You can pay me later. Pay me tomorrow. So he writes a little note saying, I promise to pay you tomorrow. And we hand over the sunglasses. Now, who owns the sunglasses? He does. And therefore we can record the transaction in our books. We've sold them for $500. They cost us $100. We've made another profit on the transaction of $400. And at the end of Tuesday, we can now do our balance sheet again. How much cash do we have? Well, we started the day with $500 in cash. If you remember, we left that behind. We went out, we bought the sunglasses on credit. We sold them on credit. How much money have we still got? We've still got the $500 in cash. So do we have any other assets? Well, we don't have the sunglasses anymore because we've sold them. But the person we've sold them to, the sunglasses shop, they owe us $500. And that's an account receivable or a trade debtor. Either way, we're owed the money. That's an asset. Do we have any liabilities? Well, yes, we do. We owe the guy down the market and we owe him $100. That's an accounts payable or a trade creditor. So accounts receivable, money that's owed to me, is an asset. Accounts payable, that's money I owe, it's a liability. And accounts receivable, also known as a debtor. Accounts payable, also known as a creditor. And so 500 plus 500 minus 100 is $900 net assets. And what about the original investment? Well, it's still $100. And as for the retained profit, we started the day with 400. We went out, we traded, we made another $400 in profit. We haven't paid any dividends, and therefore we owe $800 to the shareholders. 800 plus 100 is 900. The balance sheet balances. Now, Wednesday, all this trading is very tiring, so we're not going to do any more trading. So all we do is we come down to the sunglasses store. We say, you owe me $500. He says, I do. And here it is. So he pays us the money. We take $100 of that and pay off our friend down the market. So now he's happy. And the other $400 we take home with us and we add to our cash pile. And at the end of Wednesday, we can now do our balance sheet again. How much cash have we got? Well, we started the day with 500. We add that extra 400. We've now got $900 in cash. Do we have any more assets? No, we don't have any accounts receivable because they've paid us. Do we have any accounts payable? No, we don't owe anybody because we've paid them, and therefore the net assets is $900. And in terms of the shareholders' funds, the original investment is still the same. The retained profit, we started the day with 800. We didn't make any profit. We haven't paid any dividends. We still owe the shareholders $800. 800 plus 100 is 900. The balance sheet balances. So last day, it's Thursday. It's nearly the weekend. We're not going to do any more trading, but what we are going to do is we're going to pay a dividend. So we're going to pay out a dividend of, let's say, $300. So you're going to get $150 and I'm going to get $150. A nice start to the weekend. And at the end of Thursday, we can now do our balance sheet. How much cash have we got? Well, we started with $900 in cash. We've paid out $300 as a dividend, which means that we've still got $600 in cash. No other accounts payable, no accounts receivable, and therefore the net assets is 600. And in terms of the shareholders' funds, well, we've still got that $100 investment, but the retained profit, we started with 800, we didn't make a profit, but we distributed $300, and therefore the retained profit is 500, and 500 plus 100 is 600, and the balance sheet balances. Rinse and repeat ad infinitum. And so what we see here is that the balance sheet is a snapshot in time. It's a picture of the business at a particular point in time. And the only two things in the balance sheet are the assets and the liabilities, nothing else. And the balance sheet at the end of one day is the same as the balance sheet at the beginning of the next day. The balance sheet at the end of last year is the balance sheet at the beginning of this year. And so the income statement, or the profit and loss account, is our trading account. It's a journey over time. And the only two things in the income statement are the sales and the costs. And in my example, we're showing the trading for a day. Your management accounts will typically show it for a month, and the statutory accounts generally for the year. The other thing to notice is to compare the profit figure with the movement in cash. Because if we look at Monday, on Monday we started with $100 in cash, we finished with $500 in cash, our cash increased by $400 and we made a profit of $400. But on Tuesday we started with $500 in cash, we finished with $500 in cash. There was no increase in cash, yet we still managed to make $400 in profit. And on Wednesday, we started with 500 in cash, we finished with 900 in cash, we made an extra 400 in cash, and yet we didn't make a profit. And this is a really important concept in business finance. Profit and cash are not the same thing. You can make a profit without generating cash, and you can generate cash without making a profit. And a good example here is Vodafone in 2006. So Vodafone, they generated £18.5 billion from their trading operations in cash. And yet they recorded a loss of in excess of £22 billion, a record at the time in UK corporate history. And often I hear about companies who are profitable, but they're going through cash flow issues. And this is something we're going to pick up in module 4, is when we look at the liquidity concept. So yes, profitability is important, but also cash is really important as well. So how a company trades, understanding the relationship between the balance sheet and the income statement.